I have a client whose mortgage fixed rate is expiring next month in February 20th, and this is what we're doing for them. So to give you a bit of context of the background information of this client, because a lot of people who watch these videos like to apply it to their own situations and find it really helpful when I'm breaking it down. So basically, these are first home buyers. They approach us to get them a home loan. Their property purchase was in Alexandria apartment. Really good price for 920K, which we helped them negotiate, tactics to get the price down. We got them a loan at 80% because they want to avoid mortgage insurance, and they had 20% deposit. So the loan was $736,000. Back then, we were saying, hey, maybe you should fix for 2 years. They kind of were like, rates might drop by then. Unfortunately, a bit of fixed rates remorse. But it is what it is. So it was fixed at 5.45. It settled on 30th of February 2023. It's coming to expiry on the 30th of February 2024. That's really like, what do I do? Do I roll over to the variable rate? Do I refinance? Do I stay with your current bank? What do I do? Yikes, it's only 1 month left. First of all, we run a borrowing capacity calculation to see whether they can still service their original loan. I'm using this as example with my prototype that home loan dude calculator. Again, guys, this is not financial advice, and this is just a case study. Very rough estimates, by the way. Back then in late 2022 to early 2023, their income was at $60,000, $70,000, no kids and no other debts. But right now, male applicant is now on a $90,000 income and the female applicant is at $80,000 income. One of them still has a sad student loan, marked yes. Congratulations to them, they have one pesky kid, one dependent. According to their living expenses, because kids are expensive, their monthly expenses are $5,580 per month, excluding mortgage repayments. Because of the newborn, they racked up a $40,000 car loan and a $10,000 credit card. It's fine, no judgment. That's why we do these annual reviews with our existing clients. And I have kids as well. You got to upgrade a car. You can't just go on a train and all that crap, because you got to take them to all these shows and events. So part of the review, we asked them, well, what are your concerns right now? What are your future plans? They want to free up their cash flow. Their car loan at the moment is eating up their cash flow because it's about 9 to 10%. They want to buy an investment property because they watch a lot of my TikTok and go, hey, I want to be one of those clients that build property portfolios. No problems. And also they want to spend $15,000 to renovate their kitchen. I did their borrowing capacity. We got to tweak some things. It can be achievable, but the main thing about it is there equity in their property? Let's find out. Part of our service, we do a free computer valuation on their property. In the apartment, it's now worth $1 million. God damn. I personally think they did pretty well buying this apartment because it was worth $920K. Now it's worth $1 million in about 12 months. Their original loan was $736K, as I showed you before. And basically, we could actually value against 80% of $1 million, which is $800K, which this difference minus that, they can get $64,000 cash out. Now, I have prior consent from the client to show you this because it's for TikTok purposes and I'd like to educate other first home buyers. The original loan was $736. Yes, their rate is 5.45 and they can't get this rate at the moment. Q, yeah, we didn't listen to you. We know we should have fixed for 2 years, but what is the next best thing for us right now? And I showed them the solution. Based on my calculation, their repayment at the moment on 30 years at 5.45 is $4,155.87. So I put it here. And I did a series of comparisons of them, and for legal purposes, I had to black out the logos and the brands and stuff like that. Because by the way, those lenders watch my TikToks and go, why are you promoting that bank and not our bank? Blah, blah, blah. All that bitchy politics stuff, right? I don't want to get into that because this is just a case study. Now, based on that bunch of lenders, which I have over 25 lenders, and I'm not loyal to any of them, all right? But just say product, services, offset account, they chose 6.14. Calculating the repayment per month on that rate will be $4,479.16. It means they're paying $323.29 per month. And I know, damn Q, that is a lot. But you got to compare it to what they've, offered in terms of the existing bank rolling over to. They got a letter from their bank saying their 736 for their existing bank will be rolled over to 6.5, which means if they do nothing, their repayment will be 4,65202. Compare this to this one over here. If they moved, they'll be saving 172.86 per month by moving. Not only that, guys, simultaneously, from doing all this, we got to address their other concerns. They want to free up their cash flow because their car loan is pretty high. So we're going to consolidate that. They also want to buy investment property. Is that feasible? And also they want to renovate their kitchen. So let's look at how the potential $64,000 cash out, which they can service, by the way, will help them achieve this. The current car loan with who, smashing them by $996.44 per month. They consolidate this within their home loan, which is at 6.14. Over 30 years, it's 243.43. I know what you got to say, Q. You should encourage people to consolidate their 5-year car loan into a 30-year mortgage because it's much interest over the long term. I know. That's why I said without financial advice, it's best to set this loan on a direct debit over 5 years repayment so that the repayment is not that low, but it's actually $775 by this, they can pay off this as if it's like a car loan. So by consolidating this oh what a feeling car loan of $40,000, which is charging them $996 per month, we can turn it to $775. They're saving $220 per month. The good thing about this strategy is the default loan term is actually 30 years, which means their default repayment is actually $243.43, which means even though they're set to pay $77.92 for 5 years to pay out the $40,000 car loan, for example, they hit cash flow issues, they can revert to just paying $243.43, which is on their loan contract, which means they have a buffer of $532 per month. Just in case they have another child and there's a maternity leave in between, the wife's not working, they can revert to that. They're not forced to pay that fixed amount like the car loan. From our annual review in terms of freeing up cash flow, this part is addressed. That's done, 40K, tick. Now they want to do the $15,000 kitchen. That is also possible from the $64,000 cash out over here, which means addressing they want to buy investment property. Well, they've only got 9K left from, the 64K cash out. That's when I have the no BS heart chat with them, guys. You can do the kitchen, you can consolidate your car loan, but with 9K, with no much money left in your bank account, you can't really get much with 9K. And plus, you're pretty much maxed out your, borrowing capacity. That is why we set up another plan on my calendar for next year's review. Based on the extra cash flow by consolidating the car loan, they have an extra 2640 by the end of this year. And also if they are planning to earn more income, which the male applicant might go to executive level, earning another $30,000 to $40,000. And plus with the new kitchen in the existing property, there might be more equity from this property to be cashed out in the future. Maybe it'll be worth like 1.1 or 1.2. Who knows? But it's trending forward because Alexandra is in the NOS. That place is pretty hot at the moment because a lot of clients bought in that area and it's going up. Out of the 3 goals the client wanted to discuss with me, this was done. So in terms of buying investment property, we made a working plan for the next 12 months. Their homework is to get more income, more savings, and also hoping there's equity in their property to pull out, which in 2025, they plan to buy a 500K investment property and all they need is 85K savings, either from equity or capital growth. For you guys who've watched thus far, hopefully you have got a bit of insight to what you can do for your own situation with this scenario I'm doing with my client. As you know, I'm a type of person that doesn't like doing like teaser content, 20-second, how I did this for a client, and then, just contact me. No, this is like information for you to see the behind the scenes. You can choose to contact me. I love to talk to you, or you can take this back to your banker, broker. I don't really care, right? And that's the way I roll. If you're attention deficit and you want a shorter video, I'm not the right channel for you. So hopefully I get to speak to you. Otherwise, this information gives you insight. Jump in the comments if you have any other questions.